Robert spent 37 years as an engineer. He read every personal finance book he could find, and every single one of them said the same thing about annuities. Don't buy one. Too expensive, too complex, too much commission. Walk away. So Robert walked away. And then he sat down and actually did the math on what he had. And for the first time, he understood why a certain kind of retiree keeps buying them anyway. Not because they were tricked, because they had a problem that nothing else actually solved. Here is the problem. Robert has $800,000 saved. Social Security pays him $28,800 a year. His fixed expenses, mortgage, insurance, utilities, food, run about $50,000 a year. That leaves a gap of $21,000 a year. Now, Robert is smart. He knows he can draw from his portfolio to fill that gap. And for the first 10 years of retirement, that probably works fine. But Robert is 68 years old. His grandfather lived to 94. His mother is 89 and still sharp. The math question he cannot answer is, how long does the portfolio need to last? If he lives to 85, he's probably fine. If he lives to 94, the way his grandfather did, and the market drops 30% when he's 76, he may be spending down the wrong portfolio at the worst possible time. The technical term for this is longevity risk. The plain English version is you don't know how long you're going to live, and neither does anyone else. Every traditional strategy, the 4% rule, the bond ladder, the dividend portfolio, has a version of the same failure mode. Draw long enough, in a bad enough sequence, and you run out. The income rider on a fixed indexed annuity was designed to eliminate that failure mode completely. To understand why the modern version exists, you need to know what came before it. The original retirement annuity was called a single premium immediate annuity. You hand the insurance company $300,000. They hand you a check every month for the rest of your life. The day you die, payments stop. The insurance company keeps what's left. Simple, clean, mathematically elegant, and psychologically almost impossible to do. Because handing someone $300,000 and never getting it back, even if you die the following year, is not something most people can bring themselves to sign. Even when the math is perfectly reasonable, the emotional barrier is enormous. So insurance companies invented a different product, one that lets you keep your money and still guarantees the income. A fixed indexed annuity with an income rider runs on two separate tracks. Track 1 is your account value. This is your actual money, the $300,000 Robert put in. It grows based on a stock index, like the S&P 500, but with a cap on how much you can gain and a floor that prevents losses. In a bad year, it doesn't go down. In a great year, it doesn't capture everything. A typical year might credit 2 to 5%. Track 2 is something called the benefit base. This is not your money in the traditional sense. You cannot withdraw it as a lump sum. You cannot pass it to your heirs as a pile of cash. It is a number, a formula, that determines how much income you will receive for life. And here is what makes it compelling. The benefit base grows at a guaranteed rate, typically somewhere between 8 and 10% per year, regardless of what the market does. Robert puts in $300,000 at age 68. He does not turn on the income immediately. He waits 7 years. At 8% per year, simple growth, the benefit base has added $168,000 by the time he is 75. His benefit base is now $468,000. At age 75, Robert turns on the income. The payout rate, which increases the longer you wait, is approximately 6% of the benefit base. 6% of $468,000 is $28,000 a year. That is $2,300 a month, every month, for the rest of his life, even if his account value eventually drops to 0. Even if he lives to 100, the gap of $1,800 a month is covered, permanently. Now, that coverage is not free. The income rider costs approximately 1% of the benefit base per year, deducted from the account value. In year 1, that is $3,000. By year 7, as the benefit base has grown, it is closer to $4,500. And the money is committed for typically 7 to 10 years. There are surrender charges if Robert needs to pull everything out early, though most products allow him to withdraw up to 10% per year without penalty. So the honest description is you are trading liquidity and upside for a guaranteed floor. Whether that trade makes sense depends entirely on what Robert needs the $300,000 to do. Two things that often go unmentioned. First, the tax treatment. Robert funded this annuity with after-tax dollars, money he already paid tax on. So when the income payments arrive, a portion of each check represents a return of his original investment. That portion is tax-free. Using the IRS exclusion ratio, roughly 40% of each payment he receives in the early years comes back to him without any additional tax. The remainder is ordinary income. Compare that to an IRA or a 401k withdrawal, where 100% of every dollar is fully taxable. The annuity income is structurally more tax efficient, at least until he has fully recovered his original investment. Second, what the guaranteed floor does to the rest of his portfolio. Robert has $500,000 remaining after the annuity purchase. Because his essential expenses are now permanently covered, he does not need that $500,000 to be conservative. He does not need to hold heavy bonds to protect against a bad year. He can invest that money in a way that actually reflects a long-time horizon because he has one. The annuity doesn't just provide income, it changes the optimal strategy for everything else he owns. A fixed indexed annuity with an income rider makes the most sense when three conditions are true. 1. You have a gap between your guaranteed income, Social Security, a pension, any fixed source, and your fixed monthly expenses. The bigger that gap, the more valuable the guaranteed floor. 2. You do not have a pension. If your employer already provides a lifetime income stream that covers your needs, you may not need to buy what the annuity is selling. You already own it. 3. You are comfortable committing funds for the surrender period, and you have enough liquidity elsewhere to handle unexpected expenses. The income rider is not a growth strategy. It is not the highest return option in any scenario. It is insurance against the specific risk that your money runs out before you do. Robert did not buy the annuity because his advisor told him to. He bought it because he finally understood what he was actually purchasing. Not a return, not a speculation, a guarantee. And once the floor was in place, he stopped doing the math on whether his portfolio would last. He knew it would. If you have a gap between what comes in guaranteed and what goes out fixed, this is the question worth asking. Is there a version of this product that fills exactly that gap at a cost you can calculate? Because the annuity nobody explained to you might be the one that changes how you manage everything else.